There are many investment products available today. Let us take a brief look at what they are and their pros and cons. Let's begin with fixed deposits. These are held for a fixed amount of time and earn a fixed interest rate with a short income. While they are readily available, are easy to buy, and offer predictable income, the interest you earn is limited. It is taxable, and you may even have to pay penalties on premature withdrawals. The Public Provident Fund, or PPF, is backed by the central government and allows you to invest small savings with an expectation of reasonable assured returns with certain income tax benefits. But investments in PPF are locked in for 15 years and cannot be even partially withdrawn before the end of the 6th year. Also, since they are not market-linked and only give you a predefined interest, you may miss out on gaining from a booming economy. Some of you may also like to buy land and property, which can then be rented or sold, thus giving you a regular income. The physical and emotional satisfaction of owning a home is great, and if you plan well, you can even save some tax on your home loan. However, there are a lot of disadvantages of real estate as an investment. It takes time, money, and a lot of effort to even identify the right property. Of course, it is very expensive and then requires timely maintenance. It also involves heavy paperwork, and identifying trustworthy developers can be a problem. At times, project timelines can get extended, and thinking about all these factors can cause you a lot of stress, not to add the high search costs. After all this, predicting a rise in real estate prices is extremely difficult, and what you buy may not increase in value, or you may have to wait for very long before you can find a buyer to sell it at the price you want to reap the benefits of your investment. Let's look at gold now. The biggest advantage of buying gold is that it is tangible, and as you can see it, touch it, and feel it, there's a sense of reassurance regarding your purchase. Changes in gold price are generally unrelated to market movements, and hence gold can help you diversify risk to an extent. It is also easy to find a buyer for gold at any time. But it is expensive to buy, difficult to store safely, has high transaction costs, and any time you sell, you will lose some value. While some people buy gold as an investment, they get emotionally attached to it and don't allow themselves to sell it at the right time. Overall, it may appreciate less compared to other investment products. Government and corporate bonds are fixed-term investments which involve them paying you contractual interest or give you a fixed price at the end of the tenure. However, if interest rates rise, the market value of these bonds can decrease. Hence, these instruments are suitable for those of you who are looking to take little risk and would like to earn relatively fixed returns. Considering that the returns they offer are limited, these investments may not be suitable for very long-term investing. Companies may default on payments to corporate bondholders, and this default risk can be judged by the credit rating of the bond. Alright, all this talk about safety is great, but if what you really want is to earn a lot of money and build wealth, then what can you do with your money? How about investing in equities, popularly called stocks or shares? This is a way for you to benefit from a company's growth or profits since you actually become a small owner. Shares are traded on the stock exchange and are generally easy to buy and sell. However, stock prices can be highly volatile and therefore do not give guaranteed returns. If you can buy the right shares and hold them for a long period of time, they have the potential to deliver high returns for you to build long-term wealth. But this is easier said than done. Buying the right stocks involves a lot of effort, research, and time, and since they can be highly volatile, it also requires patience to unlock value. Also, some stocks are difficult to buy, either because they are costly or they may be unavailable to purchase. Many people lose money while buying stocks directly as they don't study the stocks they buy sufficiently and end up gambling instead. Given the constant rise and fall in stock prices, your own emotional makeup or behavioral biases can come in the way of the right buying and selling decisions. So now that you know about equity and also about fixed income, you need to understand that any one of these by itself may not be right for you, especially in the long run. While fixed income can help you earn relatively predictable returns, even though these returns may be lower than what you could earn from other asset classes, equity can help you create wealth, but while exposing you to market risks. The right mix of equity, which helps you earn growth, and fixed income, which helps you add stability, is what will help you meet your long-term financial goals. Which gets us to the important question: what if you wanted to gain from the benefits of the products mentioned till now, but by only investing in a single product? Enter mutual funds. Most experts recommend mutual funds as these are very easy to buy and simple to understand. When investing in a mutual fund, you actually get access to a combination of securities such as stocks, bonds, money market instruments, etc. in order to achieve a predefined objective. This inbuilt diversification offered by mutual funds spreads your risk across multiple asset classes like equity and fixed income, which means that you're not dependent on any one stock's or bond's price movements to earn returns. Mutual funds can help you create long-term wealth, manage risk, save tax, and a lot more. They are a retail investor's best friend and an important part of any investor's portfolio. There are many kinds of mutual funds available today. These are inexpensive to buy, and you can even invest via systematic automated investment plans that help you invest small sums of money at regular intervals. They can be bought and sold very easily, which makes them highly liquid. They allow you to access many shares which are otherwise very expensive and difficult to buy individually. Not only do they have a high return potential, but also this return comes with tax benefits. Another huge advantage of mutual funds is that they are managed by professional experts who do all the research and make all the investment decisions for you, giving you the peace of mind that your money is in good hands and ensuring that you benefit from the rising market in the long run. They also ensure that a mutual fund portfolio is suitably diversified and your assets are allocated appropriately. So, when you invest in mutual funds, your focus is on fulfillment of your dreams. However, mutual funds are subject to market risks and thus they do not provide guaranteed returns. So given the variety of funds available, you have to think if a mutual fund is suitable for your needs before you invest in them. But what should give you confidence is that the mutual fund industry is highly regulated by the Securities and Exchange Board of India, SEBI, whose job is to protect the interests of the investors. This makes these products very transparent and you will always know what is happening with your money. Before we end, please note that no one product by itself will do everything for you, but the right combination of products can help you plan to achieve all your financial goals. If you're uncertain of how to start, invest in a mutual fund or consult an investment advisor. So, choose wisely. Good luck. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.